Welcome to the second episode of the Oregon Small Woodlands Association Forestry Taxation series. This is our second episode of 7. Today, Clint Bentz will be focusing on how you are classified determines how you are taxed. Before Clint comes on, I'm not going to do an introduction for him today, but if you'd like to see his introduction again that I gave him at our last session, I'll be posting the link to our website where we're currently uploading any handouts and PowerPoint slides that Clint prepares for this seminar or for these webinars, and you can download them from our website as well as watch previous videos. Without any further ado, same things last time. If you have any questions, please use the Q&A box. To find the Q&A box, if you're on the computer or on a smartphone, you can touch your screen or move your mouse, and you want to find the box that says Q&A. Put your questions there, and we'll be monitoring that throughout. If you have any questions, don't hesitate to put them in there early. Dr. Cushing will be in the Q&A, keeping an eye out and seeing if she can answer any of your questions before Clint answers them at the end of the day. If you have any technical questions, those can be posted in the chat box, which you can find right next to the Q&A box. Well, Clint, if you're all ready, I think I covered everything I'm supposed to say.
Great. So is my screen up there, Jeremy?
Yep, I see it. Looks good to me.
Perfect. Well, welcome back, everybody, and I'm glad to see so many people attending this webinar. And so this is the second of 7 in this series that we're doing. And so last time we talked about an overview of timber taxation and deducting casualty losses. Today, we're going to be talking about how you are classified, determines how you are taxed. I think this is going to be a really interesting session. We've already started having questions from people coming in saying, okay, I know I'm classified as one thing. How do I change my classification? So we'll be addressing that. The next time we get together on the 30th, we'll be talking about income. On the 13th, we'll be talking about deducting expenses. On April 27, we'll be looking at capital expenditures and repairs and maintenance and purchasing equipment, things like that. May 11, choosing a form of business and some just kind of miscellaneous issues. And then the last session will be understanding Oregon's property and harvest tax programs. All of you should have received a couple of different series of handouts, and I apologize for that. Tammy and I were working back and forth on some issues, and I think so the last ones that were just sent out an hour or so ago are the ones that we want you to keep. The main thing that changed in last time's session was on casualty losses, and I had stated in there that all casualty losses were limited based to federal disaster areas, and that is not true. The only losses that are limited to federal disaster areas are personal casualty losses. Business casualty losses are not limited to personal disasters. And so the question that had come up was, we had the ice storm, and people had experienced damages with the ice storm. And so if you hold your property for investment purposes or for business purposes, then you are able to claim a business casualty loss. But if you're holding it for personal purposes, so like it's part of your personal residence, or it's vacation home, or something that your primary purpose is holding that is to hold it as for your own kind of personal use and not for profit motive, then the loss would be limited, because you wouldn't be able to claim a loss because we don't have a federally declared disaster area for the ice storm. Also, there's a difference in how those losses are deducted between the personal and the business, and I've included that information on that outline. Basically, business losses are deducted, business casualty losses are deducted as a capital loss, with the excess carried. If you are not able to deduct it all this year, the excess carries forward. If it is a personal casualty loss, then is treated as an itemized deduction. And in fact, even if you take the standard deduction, you can also add the casualty loss deduction to it. There's instructions in the Schedule A in terms of how you do that. So the casualty loss is treated as an itemized deduction, and any of the casualty loss that you can't use in 2020 is lost. So if your 2020 income is not big enough to offset the casualty loss, then what is left over is lost. The other thing that I have in here is that, and I've got the information on if your 2019 income was bigger than your 2020 income, because this was a federally declared disaster, you can elect to move the loss to 2019 and have it be offset against your 2019 income rather than your 2020 income. So all that is in that handout for week 1, the revised handout. All right, so let's go on to what we're going to be talking about today. So if you've printed out the handout, this will be on page 1. So our outline for this class, so no, actually it is page 2, sorry. So we've got 6 types of timber taxpayers. We'll be talking about each of these classifications. So the first one, timber activity classified as personal, which means it's non-business, non-investment. So these would be things like your personal residence and other personal use assets where you don't have any expectation of income. And so for personal use, the main thing you remember is that income is recognized, gains are not, gains are recognized, but losses are not deductible. So if it's a personal thing, if you have income, you recognize the income, but if you have a loss, you can't deduct the loss. Timber activity classified as an investment is where you've purchased it, you're holding it as investment to generate income in the future. And so we'll talk about what that means. Timber classified as a hobby. That's the classification the IRS wants to put you in. So we'll talk about how to stay out of that category because that's a horrible category to be in. Timber classified as a passive business or as an active business or as incidental to a farming operation. So some of you have a farm that you're operating and maybe you have some timber that's associated with the farm. So we'll talk about when you include that on Schedule F and when you put it on Schedule C. Thing to remember here is that timber is not classified as an agricultural activity for most purposes. So, but we do have some ability if you are operating a farm to include incidental timber revenue in your farm rather than have to break it out separately. We'll also be talking about the passive loss rules. The passive loss rules, basically, these were put into place in the 1986 Tax Act. There's about 300 pages of regulations. We're going to talk about it for 15 minutes probably, and have just a couple pages here. So we're really at 30,000 feet on the passive loss rules. But basically, the reason the passive loss rules were put in place was back in the 80s, and prior to 1986, there was this huge activity that was going on in creating tax shelters where people would start up a business and they would then they would get investors to come into the business. And these investors, by being owners of the business, would be able to take deductions that were far in excess even of their investment in the business. And so these rules were put in place. Basically, they divided income into 3 different, what they call buckets. We've got our active income bucket, which includes our wages and our income from businesses in which we materially participate. And then we have our passive income, which is our income that we get from businesses from which we don't materially participate. And rental real estate was put into that category. And then the third category was what we call portfolio income, which is interest, dividends, and sale of our capital assets. So, sale of our investment income. So in order to be classified as active, and we'll talk about this, you have to meet the material participation standard. So we'll talk about that. And the big thing is that losses from these passive activities cannot offset income from either the active activities or our portfolio income. So those passive losses are suspended. They're carried forward until such time as we have passive income. So before these passive loss rules came into place, people were looking for these types of investments where, like a mink farm or something, you'd invest, $10,000 and you'd get back $100,000 of tax benefits. Now people are looking for passive income generators, what we call pigs, where they're receiving passive income in order to offset the losses they have from their businesses. All right. Also, income from passive businesses and income from investments on our portfolio income are subject to the net investment income tax. So we'll talk about that a little bit as well. Okay, so let's get into this. So timber activities classified as personal. Now, all of these classifications, we go back here, all these classifications are based on really three things. They're based on your facts. They're based on what you intended to do when you bought it, what you're actually doing now, and what your situation is as a taxpayer. So we're kind of looking at all three things: what your intent was, what you're actually doing, and how this activity fits into all of the things that you do to live, to make money. So if we look at personal, so personal is kind of easy to think about. So it wasn't purchased with the primary intent of making a profit. So you buy your home. Generally, as your primary purpose for buying a home is to have some place for you to live. It's not, you might in the back of your mind be thinking, yeah, and someday, it's going to go up in value and I'll be able to get money, but that's not really the reason you bought it. The reason you bought it was to live there. And so the primary purpose that you acquired it was for personal use. Cars, furniture, the cabin by the lake, all these things, if you bought them primarily for your personal use and not for business use or not for investment. And we're going to talk about what that primary use is when we get into timber classified as investment. So the IRS has a bunch of things we look at when they're trying to figure out what your primary purpose was. So for now, we say primary intent is making a profit, is you're not purchasing it to make a profit. So as I said before, if you have a personal asset, you buy a car, you buy your house, let's say your house, and you paid, and I had clients, actually I had an employee of mine that bought a house in 2008, right before the crash. He spent $300,000 in the house, and now it's only worth $200,000 6 months later. And so if he goes to sell that house, he can't deduct the loss. If the house would have gone up in value, he would have had to pay taxes on the income. But if the house goes down in value, you don't get to deduct the loss. So with personal activities, basically, heads, the IRS wins, tails, we lose. And so you have to pay taxes on income, but not on losses. We do have a code section 121, which provides an exclusion on the sale of your principal residence. So if you sell your principal residence, let's say you bought your principal residence, your home 20 years ago, and you paid $50,000 for it, and now it's worth $500,000. So you have a $450,000 gain. You paid 50, now it's worth 500. The difference between what you paid for it and what it's worth now is $450,000. You sell it, you're gonna have a $450,000 capital gain. Code section 121 says that if this was used as your principal residence for 2 years out of the last 5, then you can exclude up to $250,000 of that gain from your tax return. And if you're married and both you and your spouse lived in the house for 2 of the last 5 years, then between the 2 of you, you can exclude $500,000 worth of gain. So in that situation where you bought it for 50, you sold it for 500, that $450,000 gain would be not taxable. It would be non-taxable on your return. You'd be able to exclude that from your income. We're going to be talking about timber. So if you have timber on the property, let's say you have a 10 acres place or 20 or 40 acres, and you've got your home there, and basically this has just been your residence. You're part of your view shed. You treat that basically as a park. This is part of your property. That all of that timber then can be included as part of your residence as personal use property. And if you sell that, you can include that timber in this code section 121 exclusion. So the gain that is part of the value of the timber that's on the property, if it's personal use, you can exclude it when you sell it. Now, if you sell the timber separate from the residence, that's not true. So this is selling the timber along with the residence. I'm now on page 3 and page 4 of the outline. So again, say the sale of timber from a principal residence can qualify as a 121 for the section 121 exclusion. If you own timber, we talked the last time about timber is treated as a 1221 asset if it's held for personal use or if it's held for investment purposes. So it's part of the real estate. It's a capital asset that you own. If it's sold, it's capital gain treatment as long as you sell the standing timber. So even if you hold this as personal and you go ahead and you need to get rid of some of the trees, either you want to cut it down because it's grown up and it's now blocking your view, or you want to do some cutting in there for purposes of to improve the stand, to make it more healthy, thin it out so that, again, so it functions better as part of your residence. If you sell the standing timber, if you sell the stumpage, that's treated as a sale of a 1221 asset. And again, if you have a gain, if the sale price is more than your cost basis, your depletion in the timber, then it's a taxable gain. If the sale price of that standing timber is less than your cost basis, then you don't have a deductible loss. There's no capital loss if it's personal property. If you cut the trees down and sell the logs, we talked about this also last time, and we'll talk about it again the next time we get together and we talk about income. But when we put a power saw to a standing timber and we tip it over and we turn it into a log, we have changed the nature of the asset. And it's no longer a 1221 asset. We'll talk about this a little bit more when we get to investments. The reality is that you would invest in timber because it's growing. It's a reasonable investment. You buy the land, the timber together. Even if you buy land and you plant timber, it's going to grow. It's going to grow in value over year. How much does a deck of logs grow in value? Would you buy a deck of logs as an investment? The short answer is no. It goes down in value every day. And so it doesn't really qualify as an investment. It's not something that you would purchase or acquire for investment purposes. It's generally something you would acquire for sale. So if you sell logs, that's reported as other income on the front page of your 1040. You can offset, if you're treating this as a personal property, you can offset your logging and hauling costs and any of your sale expenses. So any of the expenses that you had that were directly related to the sale, those can be netted against your log sale proceeds, but only to the extent of zero. So you can't again have a loss, but you can reduce the income down to zero with your sale expenses, assuming your sale expenses were high enough. The same thing is true when you're selling firewood. You sell firewood, even if you're not in the firewood business, if you cut trees down in your place and you sell the firewood, that's income. Even if it's not a business for you, it's still income. You report the income, and you can offset your sale expenses against that income. So all the direct costs that were associated with creating that. Again, if we have a casualty loss, that's treated as a personal loss. a personal taxpayer can elect 631A treatment to treat the cutting of timber as a sale or exchange. The income from the sale of logs is still reported on the front page of the 1040, but we can actually, if you use section 631A, then we're going to talk about this a little bit more, but when you use section 631A, you're agreeing, that election means you're treating this sale as the sale of business property. So actually, if you're not using 631A, you report it on the front page of your 1040. If you are using 631A, then you're required to report the sale of logs on Schedule C, and then you have the 631A gain on the sale of business property form, the form 4797. So if you don't use 631A, the sale of the logs is reported on page 1. If you do use 631A to get capital gain treatment, then you have to file a Schedule C. All right. So let's look at investment. This is where most landowners are. We hold this timber as an investment. And so again, we said timber is a 1221 asset. It's a capital asset, not primarily held for business. It's not held primarily for sale to customers. And the tax court, and now we're on page 4 in the handout, the Supreme Court, actually, this went all the way to Supreme Court, they ruled that the word primarily here in this context means principally or of first importance. So if it's not held primarily for sale to customers, and so if you're in business, like you're a warehouser or you're a typical small woodland owner who's doing this as a business, you're basically growing this timber for sale to customers. You want to, you're going to be doing log sales and you're running this as a business. If you're not doing that, if you're basically holding as an investment, and maybe you're going to sell timber and maybe you're not, and maybe you're just holding it for its growth and value, and someday you'll sell the land and the timber together, then this is an investment. We said again, cut logs are not a 1221 asset because they're generally held for immediate sale for customers. They're not held for investment because you wouldn't hold a deck of logs for investment because it declines in value by the hour as the trees dry out and the rot sets in. So the conversion of cutting the timber into a log is not considered a sale activity. It's just a conversion activity. And so the logs have a new holding period, a new cost basis, unless we use Code Section 631. So the 631A election is important because we're electing then to treat the cutting of that timber as, in effect, we're selling that standing timber to ourselves. And then we're going to sell the logs. And so we get capital gain treatment on the sale of the standing timber. We have ordinary income treatment on the sale of the logs. So, again, investors, if they sell logs, they have to use 631A treatment for this. So now, again, if you're holding timber as an investment, not as a trade or business, when you sell standing timber, you sell stumpage, that just gets reported on Schedule D as a capital gain. It's not business property, so it doesn't show up on a business property form. But if you use 631A to get capital gain treatment on the sale of logs, again, you're then now electing to treat this operation as a business operation. You're going to report the sale of logs on a Schedule C, and you're going to report the timber, the 631A gain on the timber on the sale of business property, the form 4797. There's a whole number of tests, and this is on page 5. So this is an important page to look at. So how do you know if you're holding timber, if timber is investment or not? So what do the courts look at between the classification of investment or if it's a business? So they're looking at number 1, the number, the continuity, and the frequency of your timber sales. So as opposed to isolated transactions. If you're coming to market every year or every other year, you're in business. If you're only coming to market once a decade, you're probably not in business, or your IRS would want to look to other things to see that you were in business. You'd also look then at the activity of the seller or those acting under their instructions, so the agents that you've hired. So are you making improvements to the property? Are you advertising it to attract purchases? So are you soliciting timber sales, or are you just letting people call you and say, hey, I think I'd like, I think your timber's worth something, and you should sell it. Another one is the purpose for which you originally acquired the property. Did you acquire it as an investment? Did you acquire it as personal property? Did you acquire it as part of a business? The purpose for which the property was held during the period, so what you've actually done as you've owned it. And any facts that indicate that the timber transactions are part of your occupation or contribute substantially to your livelihood. So again, they're looking at if the more that you depend on this income for your livelihood, the more it looks like you're in business. So in general, if you only make an occasional sale that's unrelated to any trade or business, the timber qualifies as a 1221 asset, and so just goes on Schedule D, and you just get capital gain treatment when you sell the standing timber, but not when you sell the logs. How about deductions if you're an investor? So basically, deductions, you don't have really deductions if you have timber classified as an investment. So we have two different, we call them carrying costs, and there's two different kinds. There's the annual costs, and then there's the development cost of the property. So the annual costs, your property taxes and your property taxes on the property, they can be deducted on Schedule A, but it's subject to right now the $10,000 limit on state and local income taxes. So you can deduct them on Schedule A, but you're maxed out at $10,000 for both, including your property taxes and your state income taxes. So that you have an overall limit of $10,000. So most people basically are not getting a very big property tax deduction. The mortgage interest you can deduct to the extent that you have investment income. So because this is not a mortgage interest on your personal residence, and so you can only deduct mortgage interest. It's called investment interest, and you have a limitation. So we look at your interest, your dividends, your interest income, your dividend income, your other investment income, and you can deduct mortgage interest to the extent of that other investment income. And then your operating costs on an annual basis, so like your insurance and other things, all of those, you have a choice. You can elect annually to either deduct them as a miscellaneous itemized deduction, subject to what we call the 2% floor. And so right now, between 2018 and 2025, miscellaneous itemized deductions are not deductible. So basically what it means is that you can't deduct them, or you can choose to capitalize them. So you can add them to your cost basis in either the land or the timber, depending on whether the cost was related to the land or the timber. It's like the property taxes would only be related to the land. The mortgage interest probably could be allocated between the land and the timber, depending on how the purchase price was allocated when you bought the property. So, and any other, operating costs that you might have would have to be allocated between the land and the timber, but you could capitalize them, and you make that election annually. So so right now, because you can't deduct those miscellaneous itemized deductions, you would just choose to capitalize those costs. However, the development costs like pre-commercial thinning, timber stand improvement, and reforestation would be another development cost. Those costs, you either treat them as a miscellaneous itemized deduction, subject to 2% floor, or you capitalize them, and this is a one-time election. So basically, the first time you either try to deduct them as a miscellaneous itemized deduction, or you capitalize them, then you're stuck with that treatment for as long as you own that property. So the development cost part, when you're making investments in the property, you either capitalize it or you deduct it as a miscellaneous itemized deduction, and you don't have, and so that's the choice that you have. And you do it, and it's a permanent election. You do it once, and you do that for all time going forward for that property. I've got quite a bit of information on that in the material, and so for help for that. And again, now this is a mistake here. So casualty losses for investment are considered business use. So I need to change that slide. So and it is corrected in the handout. So casualty losses, if you are treating this as an investment, you can deduct them as business, which means it's treated as a capital loss rather than it goes on Schedule A, and you don't have to have a federally declared disaster if your timber is held as an investment. Okay, so again, most of you are going to be in this category unless, and it's not because you want to or not want to, it's just because that's based on why you bought it and your activities, your level of activity. This is where the IRS, for the most part, is going to place you. It isn't a bad place. You get capital gain when you sell the standing timber. You can use 631A if you sell logs, but you basically can't deduct any expenses for operating the property, including, I mean, you have a limitation on your property taxes, and your mortgage interest is going to be limited to your other investment income. All right. So I've got a slide here. How do the courts, so the number of frequency of sales, activity of the seller. So these are the same tests we look to see, are you a business or not, or are an investor? So the more frequency of sales, the higher frequency of sales you have, the more this looks like a business, that you actually purchase this to hold the timber out for sale to customers. And the more this is part of your livelihood, or maybe your occupation, in your real life, you work as a forester, or you have some connection to the forest products industry, you're a logger, something else, your timber, it's going to be treated as a business. It's going to be hard to show that you're only holding it as an investment. But again, if you only make occasional sales that's unrelated to the trade or business, it's going to be classified as investment property. Hobby. This is the one that, this is a classification you don't want to be in. And this is the classification the IRS is going to put you in, or going to try to put you in, if you're going to try to deduct expenses from the tree farm. So my dad had several hobbies, and what the IRS considers a hobby and what you and I consider a hobby are a little bit different. There's some overlap, but there's a difference. And so so my dad, when he bought and sold used cars or antique cars. So he'd buy an old car and we'd fix it up and then he'd sell it. He'd do one a year, maybe one every couple of years. So it wasn't, and it was a complete sideline thing. I mean, he was a very busy real estate guy, and we had the timber thing. So the car thing really was a hobby. It wasn't really part of his income. He didn't rely on it. It was something he did for enjoyment, for recreation. However, he did make money on the sale of these cars, and he did it fairly regularly. And so whether it wasn't classified as a hobby for tax purposes, because he made money doing it and he made it fairly regularly. He had another hobby, which was collecting antiques, other antiques, farm antiques. And those farm antiques, basically, so his intention when he bought them was he wanted to basically hold them for investment. But he never sold them. He never really wanted to. And basically, we have a museum on our place, which he never charged admission for showing people off. So there was a great deal for him of kind of personal satisfaction in this. And so Um, Again, these expenses weren't deductible, but we were able to capitalize them. So timber activity classified as a hobby, if you're not holding this timber for purposes of making a profit, then the expenses are subject to the hobby loss rules. And the IRS basically looks to say, if you're in business and you want to deduct your expenses, they will assume that you have a profit motive if you make money 3 years out of 5. So if you make money 3 years out of 5, then you are the other 2 years where you lost money, the IRS will let you generally deduct those losses. It might be a passive business, and so those losses might be suspended, but they will treat you as being in business and not as a hobby. But what's the problem with tree farms? We might have, we have, a business cycle of 40 to 120 years, a different time between we plant the trees and when we actually harvest the trees. And so we generally are not making money every year. In fact, we may only make money once every 10 years, or once every 15 years, or once every 20 years. And in between those times when we actually bring timber to market, we want to be able to deduct our expenses for running the tree farm. And the IRS basically says, look, if you're not in this to make money, you're not doing it 3 years out of 5, you have to prove to us that you, in fact, are doing this as a business because for profit. So you say it has to be for profit, because if you're not doing this to make money, then the IRS is not going to allow you to take the deduction. So if you're not making money 3 years out of 5, then we have a facts and circumstances test. And we'll get to that in the next slide. But let's look. So let's say you are a hobby. If you're a hobby, your expenses, you can deduct expenses to the extent of your income that year. And any expenses over and above that are lost. They don't get carried forward. And so first of all, we can deduct our interest and our taxes because this is a hobby. It's treated as personal. And so again, we have interest, and generally it would be investment interest, or if it's part of our personal residence, we would have the mortgage interest and our property taxes. And then if that doesn't soak up all the income we have for the year, then we can take our business expenses, our cash business expenses against the income for that year. And then if we still have something left over, then we can take depreciation and amortization. But other than that, those expenses are lost, and they don't carry forward for future years. And if this is treated as a hobby and not as an investment, then the casualty losses are treated as personal. So the question is, so in this, if you get stuck in this hobby situation, you have a capital loss, a casualty loss, you want to at least say, okay, even though I'm not in this for a profit motive, this is going to be treated, I want this treated as an investment so that I can at least deduct the casualty losses. All right, so what does the facts and circumstances test look like? I've got a whole bunch of information in this because this is a critical one. And all the audits that I've been involved with the taxpayers, this is the area that the IRS attacks if you're trying to deduct expenses for running your tree farm. So they're going to say, you're a hobby. So what are the things they look at? They look at how you carry out the activity. Are you doing this the way that other taxpayers similarly situated who are doing this as a business, are you operating the same way that they are? What is your expertise in this area, in this business? How knowledgeable are you about it? And if you're not, and how knowledgeable are your advisors? So if you don't know anything, as long as you have engaged knowledgeable advisors, you're going out and you're talking to your forestry extension agents, you're bringing people in who can advise you, who do know about this business and are advising you on how to operate this as a business. How much time and effort are you expending on the activity? Here's the one that is critical, because we look at this income 3 out of 5 years, and that's cash income. But we have another income, and that is the expectation that the assets may appreciate in value. So we can include in that computation of are we making money is how much is the property growing in value, both the real estate and the timber. And so we can look at that growth in value as part of our income. for purposes of the classification. So if we're saying this thing is going to grow in value and that's part of our purpose, then we can get maybe out of the hobby loss rules. And that's really how we can take these deductions for 20 years and then pay taxes, on the income that we earn in the year 21 when we sell the timber, because all throughout that 20-year period, this thing has been growing in value. And because it's been growing in value, we can deduct expenses to run the tree farm. We look at the success of the taxpayer and other activities, your history of income or losses in that activity. Generally, when we're doing an audit in this area, we're going to look for the last 5-10 years. What has been your income? What are your losses, your expenses? If those things are way out of line with the growth in value of the property, and your income plus the growth in value of the property, then they're probably going to limit the expense deduction. So we're kind of we're locked into that income, including not only our cash income, but the kind of the non-cash increase in value is kind of the upper limit on what we can deduct for the business. The amount of profits that you have, how much you rely on the income. And this is the bottom one, elements of personal pleasure or recreation. I got called in to an audit that had gone on where the taxpayer had admitted to the IRS agent before I got involved that they really enjoyed going out to the property and cutting brush, cleaning the brush out of the ditches and things like that. That's something he really enjoyed doing and going up there. So the IRS agent just immediately said, okay, this is a hobby. You're doing this because it's a personal pleasure. It's a recreational activity. It was surprising how much time it took me to get the IRS agent off of that issue, because I said, okay, yeah, I know you as an IRS agent really have enjoy. You have a feeling of pleasure when you come to the end of the day and you've found a taxpayer that hadn't paid the right amount of tax, and you were able to get more taxes out of them, and I don't know if you enjoy it so much that even if they didn't pay, you would come to work. But we do have satisfaction from a job well done. That's different than personal pleasure from a recreational activity, and most people would not consider going and clipping brush as a recreational activity. And so now there's some people, and there's probably some people in this class, including my dad, who would said, yeah, that would have been a recreational activity, go up and cut brush. That was something that they enjoyed doing. But when we're in front of the IRS auditors or agents, you don't want to say you enjoy this, other than the fact that you enjoy it when it's done, what it looks like, but the activity itself is not fun. So again, this amount of personal pleasure or recreation in this is also something that the IRS looks at. All right, so we don't want to be a hobby. If we want to deduct our expenses, then we have to avoid these tests. And so that's why I've included them there, page 7, page 8. So this can be done, how you avoid this, and no one factor is determinative in making this, in looking at whether or not you're a hobby or whether you're a business. And so you have to, when we're looking at deducting our expenses from the tree farm, we have to have this in the back of our mind. This is the first step. So first, the IRS, if they can rule that we don't have a profit motive, then we're done. You can't deduct anything over and above your income, your cash income for that year, and all those other expenses are lost. We would have a fallback position, say, okay, this is not a business, but it is an investment, so I can at least maybe choose to capitalize the cost. The problem is by the time the IRS is caught up with you, you can't do it because you have to make these elections on your timely filed tax return. And so this election to either to expense things on as a miscellaneous itemized deduction or to capitalize them as an investment is something you have to do on the original return. You can't change your mind 3 years later when you get audited by the IRS and say, oh, Now I want to be treated as an investment. At that point, if you've deducted the expenses and they say no, then you've just lost them. You're not going to be able to get them back. So I've included that information there. This is something that you can work your way out of, but you do need to be aware of this as you're going through your activities. Classified as a business. So first of all, we have to meet the hobby lobby rules. Now we're holding out as a sale we're holding the timber for sale to customers. So that standing timber is now a business asset. It's a 1231 asset, not a 1221 asset. When we sell business assets, we don't report them on Schedule D, we report them on the Form 4797, the sale of business property. When we sell logs, we report that on Schedule C. We can elect 631A to treat, again, that's this value of the standing timber that we cut as capital gain. We'll talk about that next time we get together. The net profits on the Schedule C are treated as self-employment income. So not only is it ordinary income, but you pay self-employment taxes on that, FICA and Medicare. The passive loss rules, the Code Section 469 on material participation, are applied at the taxpayer level. So if you're in business, you're in a partnership with your brothers and sisters, the material participation rules are based on you, not on your brothers and sisters, your other co-owners. So each owner has to determine whether or not they are a material participant. So whether that is treated as an active or passive business is going to depend upon how each owner is working on it. So timber activity classified as a passive business, which means you individually don't meet the material participation standards. We'll talk about the material participation standards in just a minute. But if you don't meet, let's just right now, you don't meet the standards. So what happens? The losses then from this business cannot offset income from your wages or other active businesses or your portfolio income. So those losses are suspended in what this passive bucket, and they carry forward until such time as either you have passive income, net passive income, or you sell the activity, you dispose of the activity. So, and so we look at passive activities, each one individually, and we looked at them as a group. And so we have our losses from each one or income. We net all that together, we can come down to zero. So if we have some rental properties where we're making income, we've got our timber property where we're passive out, it's losing money, we can net those things together. And we could deduct the losses from the tree farm against the income from the rental until it gets down to zero. But we can't take a loss below zero. So then those passive losses get carried forward until we have passive income in the future, or we dispose of the activity, we sell it. So all that income, including the 1231 gains from the sale, if it's passive, are subject to the net investment income tax. If we have a casualty loss, it is treated as a business loss. What if we're an active business? So you as a taxpayer meet the material participation standard. If so, then losses from that business, so the 20 years of loss, our expenses exceed our income for 20 years, and then now we're going to harvest, now we're going to have income. All those loss years, we can deduct those losses against all of our other income. And so we can buy equipment, we can take depreciation, we do the 179 deduction, all the things we're going to talk about in the future classes. If we are an active business, we can take those deductions, and even though the tree farm is not making money, those losses can be offset against your income from your day job, your investment income. It can be offset against all your other income. And it's not subject to the net investment income tax. So the income from an active trader business is not subject to the NIT. And if you have casualty losses, it's treated as a business casualty loss. Finally, if we get into farming, generally, so timber is not considered agriculture. So you generally would not include the timber activities on the Schedule F. We can include it on the Schedule F if the timber was grown on the farm, if the income from the timber sales are not treated as a capital gain, and the timber is incidental or it's tied in with the farm. It's not substantial, and you don't have employees that only work on the timber part. You take your farm employees, you use them to do the timber part. So if this timber thing is just kind of an insubstantial activity, you can include it on the farm. Otherwise, you split it out, and you have the farmette business on Schedule F, and then the timber either as an investment or as a separate business. So if you're farming, you can have the timber on the back and hold it as an investment. So it just depends on how you treat it, your purposes, how you do it for tax purposes going forward. There are many code sections that not only treat timber, but also Christmas tree operations. They say neither one of those is a farming activity. Things like income averaging, there's a bunch of other code sections that point to a specific part of the code that basically says timber and Christmas tree operations are not agriculture. It's not farming. Okay, the passive loss rules. Again, we've got these three categories of income: active, passive, and portfolio. These rules were put in place to stop tax shelters from people for investing in businesses in which they are not involved in the business and being able to deduct the losses. So that's why these rules are here. These passive losses can't be offset against your other income. Basically, all business activities are considered passive unless you, the taxpayer, meet the material participation standards. There are 7 tests. You only have to meet one of them. I'm now on page 12 in the materials. So there's 7 tests. The first one is what we call the absolute test, which means you personally work more than 500 hours. You actually, and or your spouse. So you and your spouse are considered one person. And if you drag your spouse along, even if they're just supervising from the pickup, and maybe not even really paying all that much attention, as long as you're both there, I call this a spousal togetherness rule. As long as you're both there, you can count both of your hours for these tests, for all of these tests. So we have this first test, you work more than 500 hours. That's about quarter time. It's 10 hours a week. It's 3 months, 40 hours a week. So it's basically at 500 hours. Very few of us have that many hours on our tree farms, and so, but if you do, then you meet that test. It doesn't matter who else is working if you are working more than 500 hours. All these other tests assume you have other people involved and working. So the second one is you do most of it yourself. So you're 100 hours or less. So let's say all you did this year was you took a walk around the property, you checked the property lines, you looked at the property tax statements, and maybe you're out and did a little weed killing or something. You spent 10 hours, and that's all that you did. It was all that needed to be done. You didn't hire anybody to do anything else. Nobody else came on the property to do any other work. You're a material participant. That's an active business. You can go out and buy a $100,000 piece of equipment, take a Section 179 deduction on that, assuming you've got other wages to offset that against. So again, if you're doing all the work, then even if you don't put in 100 hours, then you are a material participant. The third one is you do have other people working. So let's say you hire somebody to come in and do some tree planting or do some other work on the property. In this case, you have to work more than 100 hours and more than any other one person. So this is if you've got, also if you have partners and you've got multiple people that are there, you have to work. So let's say somebody comes out and they work 5 hours, then you have to work 100 hours and more than any other one person. So you've worked 100 hours, which is more than 5. So you have to have more than 100 hours and more hours than any other one person. The fourth one is an interesting test. It's what we call the Significant Participation Passive Activities Test, the SPPA. This is when we have multiple 100-hour activities. So we have a lot of people who are serial entrepreneurs where they have multiple businesses that they're operating in. including maybe the tree farm is one of them. And so as long as you have at least, if you have a number of activities and you have at least that, none of them that you meet the 500-hour test in, all right? So you have a number of businesses that between 100 and 500 hours, and but you don't meet in test 1, 2, or 3 for any of these businesses. If you take all of those businesses where you have more than 100 hours and doesn't meet any of the other tests, and when you add them up, you come up to more than 500 hours, then you are a material participant for every one of those activities that you spend at least 100 hours in, more than 100 hours in. Let's say you're going to go to retire. If you have been a material participant for, you can look back in the last 10 years and find that you've been a material participant based on one of those 4 tests for 5 out of the last 10 years, then you continue to be a material participant. So basically, if you're a material participant every year, you retire, you continue to be a material participant for 5 more years. So that's the 5 of 10 years test. The 6th one we call the personal service activity test. Tree farmers don't qualify for this one. So this is a business like health, law, accounting, engineering, consulting, where you're offering personal services to people. In this one, it's the opposite. We're looking at passive income generators. A lot of people in these types of business said, well, look, I'm just going to cut my hours back, and now this is going to generate passive income for me. And I'll be able to use this passive income to offset other passive losses. The IRS says, no, no, no. If you're in a service business, if you were a material participant for any 3 years while you were involved, an owner of the business, then you're always going to be a material participant. So that was to avoid people to cut their hours back in their consulting business and now have that income become passive. It doesn't work. The final one is the facts and circumstances. I don't know that there's been a dozen people that have won on facts and circumstances since the 80s when these rules were put in place. But basically, in order to get into this test, basically what you're in tax court, you're begging for mercy. You have to have at least 100 hours. You can't have a paid manager or anyone else that spends more time managing the activity than you did, whether they're paid or not. So those are 7 tests. They're outlined on page 12. Going into page 13, I've got a whole bunch of ideas on how you can get to material participation. This is one that 13 and 14 and 15. This is the one that you want. This is the area that you want to work on if you want to be able to deduct expenses on your tree farm. So any work you and your spouse does in connection with the activity counts. It has to be work of the type generally done by an owner. So managing, planning, and doing the work. But if you have another person that you've hired to manage the place, then just going out and doing the work, you're sweeping floors, you're doing other things to just to gin up hours, that's probably not going to count. But if you're in fact doing most of the work yourself, including the managing, then you can also count your hours out, just working in the tree farm. Hours you spend in the capacity of an investor doesn't count. So if you're preparing and reviewing financial reports, monitoring and finances in a non-managerial capacity, so that means you've paid a bookkeeper to do the work, and all you're doing is just reviewing the reports that they're providing. You really can't count those hours unless you're doing it as part of your work as the CEO, or you're doing budgets, things like that to manage the property. If all you're doing it is kind of, as an investor, you get the annual report and you look it over, those hours would not count. I've got a bunch of examples of qualifying activities, walking around on the ground, developing a management plan, working on the management plan, soliciting sales, planting trees, doing timber stand improvements, attending OSWA meetings. Going to tree school, becoming educated. Remember, one of the things we talked about hobby is it looked at what are your skills and education to do this job. And so the investments that you're making yourself, improving your skills and your education also count as hours working on the activity. Maintaining expense records. The bottom line here is you need to keep records. Everything here talks about hours. The IRS doesn't have something in their records. They don't have a specific type of record keeping you need to do, but the burden of proof is on you that you have in fact done the work. And so I find many people, they keep, they have a spiral bound notebook in the dashboard of their pickup, and they basically keep a journal, or they have a day timer and they keep information in there. They have a calendar on their refrigerator and they make notes on that. Really, it doesn't matter what kind of record keeping system you have, but you need to have some sort of contemporaneous journal or log of your hours. If the IRS auditor calls and you bring in your log and the ink is still kind of smudgy and wet, and you've just created the record now, the IRS is not going to put very much stock in it. So you need to have a contemporaneous record of your hours that you worked on the tree farm to prove your material participation in order to deduct these expenses. Many people have operated in this family limited partnership. Limited partners, a family limited partnership, are passive by definition, because if you're a limited partner and you work more than 500 hours, you lose your limited liability protection under the statute, and you become, in effect, a general partner. So a limited partner is not treated as a material participant. They are treated as being passive. Now, if you're a general partner that also owns limited partnership interests, those limited partnership interests that you own are not considered passive if you, as a general partner, meet one of the material participation standards, one of those 7 standards. Limited partners can be treated as material participants if, 1, they work more than 500 hours, which then they lose their limited partnership status. 2, they were a material participant in any of the 5 of the last 10 years. So let's say you were a general partner and then you retired, you converted your general partnership interest to a limited partnership interest. Now you can continue to be a limited partner for material participant for 5 years. Or if this limited partnership was a consulting business of some kind, personal service activity. Limited liability companies do not have this problem, which is why many people, including us, changed from being a family limited partnership to being an LLC. Because now we don't have general partners, we just have members. And even we have managing and non-managing members. Basically, each member is not considered passive by definition. Each member basically just has to work through the material participation standards on their own to see if they are passive or active with respect to the activity. So this is a challenge that we have with family limited partnerships. Trusts. The material participation standards are measured by the taxpayer. So the taxpayer, is basically considered the trustee. So the trustee themselves has to meet the material participation standards for the trust to be considered a material participant and have that income go out to the beneficiary as active income. So if the trust is a partner or a partner in a partnership or a member of a limited liability company or a shareholder in an S Corp, that income is going to come out, it's going to be passive, and it's going to go through to the beneficiaries as passive unless the trustee themselves is a material participant in the business, meets the material participation rules. So finally, on page 16, I've got a chart that kind of just looks at these various categories of income and where it goes. So what is the impact of these classification rules on taxation? So look at stumpage sales. If you sell it on the stump, if it's investor or personal, it's a Schedule D. If it's passive or active, then it goes, goes on the Form 4797. So the logs, all those different things, property taxes, interest expenses, management expenses, the reforestation things, home office expense, those are only limited to businesses. Self-employed health insurance or pension deductibles are only limited to the businesses. So with that, and page 16, we will finish my talking and we'll go to some questions. So let me get rid of this. And Tammy, I'm sure that there has been a number of questions that have come in as we've gone on. And if you have questions about this material, please put something in the Q&A, and we will try to help you out.
Sure. So thanks, Clint. Great job. There's a couple questions here, and some of these came in pretty early on, so you'll be able to tell kind of where you were when these came in. If the timber is on land adjacent to a residence, but on a separate tax lot, could it be classified as an investment or a business, or is it only going to be personal if the purchase was part of the same transaction as the residence? So maybe you can treat that in two different pieces.
Okay. And so the answer is yes or no. It depends. You can do whatever you want. And so if the parcel is adjacent to the personal residence, you can treat it as part of the personal residence, even if it's a separate tax lot. So again, if you want to qualify it for the defer or for the limitation of gain, to the 250,000, 500,000 exclusion from gain, as long as the tree farm is adjacent to, if it can be a separate tax lot, as long as it's adjacent, which means the property lines touch. As long as that is, you can treat that as part of your principal residence, assuming you're using it just as part of your principal residence. However, it doesn't even have to be on a separate tax lot for it to be considered investment property or business property. So whether it's a separate tax lot or not, as long as you're holding it for either for investment purposes or you want to treat it as part of a trade or business, then that's what it is. And you kind of think, look at the farmers. So the farmers, they've got the farmhouse on the farm, and they've got then the outbuildings, and then they've got the farm ground. The personal residence part, the house, the yard, the garage, those kinds of things, that's their personal residence, and everything else is our farm assets. And if they sell that, and they can only take that section 121 exclusion against the personal residence part of the property. They basically have to split it out, and only the gain that they have on the house and the house lot and their personal part qualifies for that exclusion of gain. And the rest of it, all the farm property, is treated either as a investment property or as business property, and is either 1221 or 1231 asset. So it depends on your record keeping and your intention and what you do. So I have people come, they want to argue it both ways. They're selling it now, they want to exclude the gain, or they're going to sell it and they want to have it treated as investment. So it can go either direction.
I think the key thing you said there, Clint, that everybody should key in on is that it depends part, right? There's so many pieces to all these puzzles that it's never quite as black and white as we would all like it to be. Mm-hmm. There's another one here that's kind of similar but different, related to that business category. If you started your tree farm as a business, changed your plan so that it becomes part of your personal property, can the IRS retroactively disallow the expense deductions that you've already claimed?
So, if you go, it's going to be looked at what you were doing in the year you filed the return. So if in the year you filed the return, you were operating as a business and this expense deduction qualified as a business deduction, then the fact that you converted later and you became personal or investment, they're not going to go back and change it just because you later did it. So you're going to look at each year stands alone, and so they're going to look at it for that year. Now, if you realize you're going along and really this wasn't a business, this was an investment, and so you've just changed how you're reporting it to reflect what was actually happening, then you've got a 3-year statute of limitations. At my accounting firm, every year, April 15, we had a big party. Everybody got together. We had a lot of alcohol, and we told lies to each other and stuff. So the employees thought we were throwing this party because they've been working 80 hours a week for the last 10 weeks. But the partners, we're throwing the party because there's a whole another set of returns that we could shred now, and the statute of limitations was gone, and nobody was going to get sued or anything. So anyway.
Sounds like a good party. So we have a question on here, and I'm not sure exactly what kind of answer this person's looking for, but it says, what is the 2% adjusted gross income floor You obviously mentioned that, and that pertains to the miscellaneous itemized deductions, but if you can address that.
Yes. So on your Schedule A, we have these miscellaneous itemized deductions. There was a whole list of them, which included these investment expenses, but expenses like your tax preparation fees and the money that you spend on your investment advisory fees with your broker and things like that. And those expenses are deductible on Schedule A, but only to the extent that they exceed 2% of your adjusted gross income. So let's say your adjusted gross income was $100,000. And so you take your adjusted gross income, $100,000 times 2% is $2,000. And so you'd look at all those miscellaneous itemized deductions. The first 2,000 of them are not deductible. It's only the ones that go over 2,000. So if you had $2,500 of miscellaneous itemized deductions, only 500 of them would be deductible. The first 2,000, that would be the floor. That's what we call it, the 2% floor. The first 2,000 are non-deductible. It's only the amount that goes over that 2% floor that is deductible. The Tax Cuts and Jobs Act of 2017 made that category of expenses, those itemized deductions, those miscellaneous itemized deductions subject to 2% floor, and they said they're not deductible at all for tax years 2018 through 2025. And so we're in this period now where those expenses are not deductible, no matter what they are or how much you have. Starting hopefully in 2026, maybe they'll come back, maybe they won't. Depends on what the Congress does.
Great. So we have these clusters of questions, so I'm trying to deal with all the category ones first. So in the case of an LLC or a limited liability corporation, do you use the same criteria to treat it as an investment or as a business?
Yes. And again, these determinations are made really they're made at the individual taxpayer level. So the LLC, which is a limited liability company, it doesn't really matter what they're doing with the business. If the income is coming through, so here's the issue. So if the income is coming through is business income. So the LLC is operating as a business and it's generating business income, then really the only question for you as the owner is this passive or active? However, if the LLC basically just owns the property and maybe is renting it out, and maybe or the LLC just bought it to hold it. So, like for example, I have a client who bought some property and they're thinking maybe at some point they would sell it to a developer, and so they're just holding it. They're not generating any income from it, and it is an investment there. Then for the individual owners, that would also be considered investment income. So it basically depends on the type of income that flows out of the LLC. If it comes out as business income, then it's either passive or active based on your material participation. But if all that's coming out of it is interest, dividends, capital gains, things like that, there's no business income coming out of it, then you're an investor with respect to that activity.
Great, thanks for making that clear. With an LLC tree farm with family members that each get a K-1 showing their share of the LLC expenses as an ordinary income loss, are each of them supposed to meet the passive test? So I guess we're talking about each family member and how they're gauged for active and passive.
Yeah, and so let's look at my family as an example. I think we have 18 partners at this point. And there's only 2 of us that are active and all the rest are passive. So each person, including they're units. So each married couple and each other single individual as either married couples or as individuals, they have to meet those material participation standards by themselves. And if they don't meet the material participation standard, then the losses that flow out are suspended at the individual level. So they're suspended on their own tax returns. We don't suspend the losses at the partnership level or the LLC level. they're suspended on the individual's own tax returns. So, and this happens with us. So we've got, years where maybe we have 4 or 5 years where we have losses coming out. The managers, the people that are working in the business, they are taking those deductions, those losses every year. But the other partners basically are suspending those losses every year. And then when we sell timber, managers recognize the income because we don't have any losses that carried forward, but all the other partners, they can take those losses that had been carried forward and apply those losses against the income that was earned when we sell the timber. So nobody loses anything, just a matter of timing when they can take the deduction.
Great. Okay, so moving a little bit into material participation. So if you do all the work yourself for 5 to 10 years, but only 10 hours per year, and then you hire someone to plant trees 1 year, do you meet the material participation standard since you have managed solely for 9 out of 10?
Yes, you only have to meet one test. It'd be a different test every year. So if you can look back, actually in year 6, if you hired somebody, so you fail the material participation standard in year 6, as long as you can look back in the last 10 years and find 5 where you're a material participant, then you're a material participant that year. So you just look, each of those tests, you only have to meet one of them. And yeah, so as long as you can meet one of them, you're a material participant.
Great. Okay, so we're going to move a little bit into some cleanup from last time, some things that people processed from casualty losses. Either they've seen the material since or know that you talked about it last time and have some questions for you. So I had processed logs on the ground that then burned. Can I deduct the amount that I would have gotten from the mill as a casualty loss? So if you can talk about how that casualty loss calculation might play out with on the ground logs.
Yeah. So first of all, you would start with what would have happened on your tax return if the fire wouldn't have been there. So if you were this was a business and you were going to make the 631A election and treat that and get the capital gain part. So this is a business activity. Then yes, everything that you lost as part of this business is included in the casualty loss, including equipment, including your timber, your logs on the ground, fences. I mean, all that stuff that burned up is part of your casualty loss. And as long as it was business property, it's all lumped together. And the loss you can deduct is the difference between what its value was immediately before the fire and what its value was after the fire. The lesser of that number or your cost basis. And so you can aggregate all that stuff together. If this was a and I think it's also be true if this was an investment activity, and you were selling the logs, and I think even then, if it got in the middle, that the logs would be part of this. If this was just part of your personal residence, your house burned up and the trees burned up around the house, then you would have a personal casualty loss, and you would in fact have 2 losses, because for personal casualty loss, you have to look at each thing that you lost separately, and you measure your basis and the fair value reduction for each thing that was lost. So you look at it for like hurricanes, things like that. Your house gets done, your car gets destroyed, you lost all your personal possessions, your clothing, your furniture. Each one of those is considered a separate casualty loss and for the computations. But for business, you lump it all together.
Great. All right. So here's another casualty loss or disaster question for you. How are losses calculated? You answered a little bit of that. For example, I lost 40% of my canopy in the last storm. How is it affected by a disaster classification? And I guess what's not been stated in here is whether we're talking about my yard trees or if I'm talking about something that is business property.
Yeah. So again, the loss is determined by appraisal. And so And if we assume it's a business loss, we don't have to worry about whether it's federally declared disaster. So like we were talking about the ice storm, for example, and you had a bunch of the tops broken out of your trees with the ice storm. If this is a business loss, or you're treating this either as investment property or as business property, then you would do a valuation of the timber stand before this ice storm and after the ice storm. And that timber has suffered. It is worth less now because it's not going to grow up into a big, tall tree. It's going to be limited to one log or whatever that is. It may even, now be subject to fire, insects, and disease because the top is missing. And so the stand itself will have declined in value. And so you would look at that decline in value as determined by appraisal compared to your cost basis in that timber, and assuming you have some. So if you had planted that timber and you had deducted all your reforestation costs when you planted it, then your cost basis in that stand would be zero. So you have to look to see, do you have cost basis in the timber stand? And the stand is determined, it's determined based on your depletion unit. We'll talk about depletion in I think 2 classes from now. We talk about deductions. But it's based your cost basis in the timber, and it depends on your at what level you're keeping your cost records for your timber. And so for most people, it's all your property. Some people have it broken up property by property. Some people actually go down and break it up stand by stand. So it really kind of depends on how level of detail you have for what cost basis number is applicable.
So Clint, while you're talking about assessing value before and after, some people are qualified to do their own, right? We talk to foresters all the time that know how to do their own work and certainly could write it on their own letterhead. But the question is whether it's bad form to do your own appraisal, if you're qualified, and how the IRS would probably view that if I was putting that assessment on my own land.
That is a very good question. And I think I actually looked that question up. And I think it would be in the instructions of the form of the casualty loss thing. And I believe that in order to deduct the casualty loss, you have to have a qualified appraisal. And by definition, the taxpayer can't perform a qualified appraisal because it has to be done by an independent person. Now, that doesn't mean that you can't do all the work and then go to your best friend who's also in the business and say, would you put this on your letterhead to reduce the cost? So, but yeah, even if it isn't required, yeah, the IRS is not going to buy your numbers, even if you are in this business, because you can't be independent with respect to your own activities. And so you should get a appraisal done by somebody else, even if you do most of the work. That's fine as long as the other person is willing to accept responsibility for that work and put their own license on the line for it.
Great. So, you've talked about whether you're personal or investment, and we've talked about business, we've talked about hobbies. Where does C corporation fall into this, S corporation? So, we've got all these business org types as well. How does that interact with these categories?
Yeah. So, C corporations, which are regular corporations, also are subject. Well, no, C corporations are not subject to these rules, I don't believe, because they're, a C corporation is assumed to be in business for itself. So C corporation, if it's doing things, because it's a separate taxpayer, it's going to be doing things. Now, actually, a C corporation can have non-business activities inside it. So let's say the C corporation owns the vacation home. It can't take deductions for personal use assets. So that's how the C corporation does it. If it has non-business assets, it can't take deductions for those non-business assets on its tax return. So that's That's how a C corporation is treated. So it pays taxes on its income, and it can't take, because it can only take deductions for its business activities or activities entered into for a profit. But in terms of material participation, passive active, that doesn't really come into play. It's just whether or not it's an investment or business activity, or whether it's a non-business activity. S corps, partnerships, LLCs, these are pass-through entities. And so again, whether it's a business or not, whether it's operating as a business or not, we make that determination at the business level. So at the LLC, partnership, S corp level, again, they may have business assets, they may have investment assets, they may have personal use assets inside the entity. It's going to make its first cut in terms of how it reports its income. So it's going to report all the income out to the partners or shareholders. It's only going to deduct expenses that are related to those business activities. So again, if it's got the personal use assets, and I see this a lot where we've got family entities and it owns personal use assets because that's where the money was to buy them. And so it owns the vacation home in Black Butte or down at the coast or something. And so those expenses, because it's not a business asset, are basically not deductible, or they're passed out separately to the owners so they can deduct them as, the property taxes, things like that on their individual returns as a non-business asset. The question of passive or active, though, is determined based on the individual owners of those pass-through entities. So whether you meet the material participation standards depends on each owner has to meet those activities, meet that standard or not. If they don't meet the standard, then it's going to be passive income to them.
So Clint, this has been a lot of information today, right? This is always one of those topics. And so somebody asked this, what I think is probably going to be our last question. And so I'm going to post this challenge to you. The question was, I'm still a bit unclear whether our timberland should be classified as an investment or as a business. Can you summarize how land, how people should think about it? Like, what should their considerations be between investment or business, and then of course personal?
So I think really the question comes down to whether or not you would like to deduct expenses for operating your tree farm. That is the first question you need to ask yourself. If you really don't have any expenses for operating a tree farm, you basically bought this property, it's growing, you've got the trees planted, and yeah, you're going to maybe spend some money, but you don't care about deducting it, then treat it as an investment. It's simple. When you sell the timber, if you sell the standing timber, it's treated as a capital gain. You don't have to mess around with all these other schedules. So it's the simplest way to do it. And if you don't care about deducting expenses, that's really probably what you should do. Now, if you are harvesting every year or every other year, I mean, you're doing a lot of activity with this tree farm, and you're making some fairly significant expenses. You're buying equipment, a cat or Traco, you've got other things you want to buy, and you want to be able to write it off for purposes. Then you need to figure out how can you get yourself qualified as a business, either active or passive. And if you're going to do that, then you have to look at the hobby loss rules, you look at the material participation rules, you look at all those things to get yourself into that status. Because if you're going to make the deduction, you want to make sure that the IRS doesn't come and take those deductions away from you because they say you're not in this to make a profit. And that's really a business. You're in a business to make a profit. You're probably not going to make a profit every year or 3 years out of 5. And so you have to build the case that even though you're not making profit 3 years out of 5, you should be able to deduct these expenses because overall, this thing's growing in value and we are off going about this in a business-like fashion. One of the biggest issues there, if you're going to do this, is a management plan. The IRS looks to say, do you have a business plan for this business? Most well-run businesses have some sort of a business plan. For us, our business plan is the management plan. So by having a management plan, you've gone a long way to getting there. For me, as a tax professional, the most important part of your management plan is your statement of purpose right up front. And your statement of purpose generally has lots of things in there. It has, for the family, and might have, to create habitat for butterflies, and you might have lots of things in there that maybe are, they're your own personal passions, there needs to be at least one line fairly close to the top that says, I'm doing this to make money. that you're doing this for commercial production of timber, with all these other things. So if your thing is, I'm setting this up and I'm never going to harvest, I'm never going to do anything, and this is just for wildlife habitat or something, that's fine, that's great, but it's not a business. It may not even be an investment. So you have to watch, see, because investment, you have to be in this for the production of income, even if that income is the growth in value over time. And so you need to make sure in the management plan, as you put those statements in there, that while that you do want to express your passions, you also want to be talking about the money part, because the money part is what the IRS cares about when you go to want to claim costs and deductions for the tree farm.
Thanks, Clint. Jeremy, that's all the questions we have. So back to you.
All right. Outstanding. Clint, closing comment, and then after that, I will talk about our next session.
Great. Well, thanks everybody for being here. Next time when we get together, we'll be talking about income. So we'll be getting into the Section 631A and some of these other things more in more depth. And so I look forward to having all you back on March 30th. And we'll be talking about all the different ways that how we treat income based on classifications of what type of owner you are. And we'll kind of dig into this more deeply next time we get together.
Outstanding. Thank you, Mike, for putting up the slide from earlier. Yeah, March 30th, which is next Tuesday. We're not going every other week for this next one. After the 30th, we'll return to every other week. I just posted the link in the chat to our website for the page specific for the Forestry Taxation series. I will continue to update this with the videos as well as Clint's handouts and his slides when I have them. Thanks again, everybody. Really appreciate everybody coming out.